Good evening, everybody. My name is Julianne Peterson, and I welcome you to tonight's Zoom at 8. We are here every Tuesday night without fail, and tonight will be nothing like you've ever heard. We've got two rock stars tonight talking about insurance, because insurance is putting huge impact on underwriting these deals. So we're trying to figure out, how do we minimize it? A couple months ago, probably a month ago, we heard from Tony O'Day, who talked about how to fix our insurance policies in case we had a fire or a loss. So tonight we're going to try and figure out, how do we reduce it? What are the items that can really result in some savings on the expense side of things? But again, my name is Julianne Peterson. I'm with Old Capital Lending, and we are a provider of debt for mostly the multifamily asset class, but we'll go into other mobile home parks and senior and student housing. Any of the commercial loans we can help, but we really are specialists in the multifamily. We start at 5 units and $1 million loan amount. So I'm happy to go over those details with you. But if you're looking at something, I'd love to have the opportunity to take a look at it. And when you're part of Zoom at 8, and if we're doing a transaction, I welcome you here tonight and all of our future Tuesdays to come and provide an opportunity for others who are joining here that may want to jump into your deal. Not everybody needs to be a GP on a deal. There's lots of room for limited partners, and don't be waiting and holding on to your money, because maybe there is a great opportunity in a limited partnership. So we have closed 6 deals in this room, and I'm looking for number 7, lucky number 7. Tonight, we're going to get an overview of something that can really affect the expense side of the business. And that, as I mentioned, is the insurance. Okay. And so JT is here, and Paul Kaliades is here, and they're going to talk to us about an option that you can take out for your tenants that will help protect you and reduce your insurance policy. So I think JT did an amazing job with his introduction. You didn't leave out anything, JT, about yourself, so good job. The only thing that I would say is that JT is married to Jessica and has a son named Liam. So that's about JT. And then Paul is he's been in the multifamily insurance experience with over 30 years in this arena. He does property management, sales, and development, and he's earned a national reputation for guiding multifamily companies through critical stages of development. He's a president and partner, and he's developed and directed RLL. He's with RLL Property Damage Liability Waiver Program into regional multifamily markets throughout the United States, with 500,000 units participating. So how the heck are you going to reduce my insurance policy? You guys, I'm super excited to hear from you. We have a presentation that everybody should be thinking about, whether you are a limited partner or you are a general partner. This can help offset some of your expenses. If you guys would be so kind to look up at the little sign up in the right-hand side, if you'd move your view to speaker view, and then we can give all of our attention to our speakers. So JT and Paul, you take it away.
So this, we actually talked a few weeks ago, if y'all were on the Zoom, to a public adjuster on different ways that he can help property owners with insurance on their properties. And one of his suggestions was implementing a renter's insurance program for all tenants. So today I brought a guest on, Paul Kaliades, and he's going to do just that. So what I do is I provide, property, general liability, and umbrella insurance to your property, but this often goes overlooked Most of, and Paul will touch on this, most of the incidents that happen at properties are, small kitchen fires, things like that. Some of my policies that I have could have a deductible of $25,000. Well, the small kitchen fire was only $5,000. So what do? Well, you pay for that out of pocket, right? So how can we circumvent that? How can we implement a little bit more to this to help you in the event that happens? And unfortunately, it happens all the time. So Paul, do you want to get started, and then we can jump into any questions people have along the way?
Sure, JT, thank you. And Julie, thank you as well. Kemra, I also started when I was 2 years old, which explains my 30 plus years on that side. Very quickly, as Julie mentioned, I've been in this space both as an owner and manager, and for the last 20 years on the insurance side. We own and manage what's now about 15,000 units based out of northern New Jersey and New York. I live about 10 miles north of New York City in Westchester County. I know the gentleman from Long Island is familiar with that part of the world, but our headquarters are in Salt Lake City. We have regional offices around the country. As Julie mentioned, we're in some 500,000 units, and ostensibly what we do is transfer the risk of the things that impact your NOI and your balance sheets from the things that residents do invariably. And kitchen fires and overflowed bathtubs are probably two of the major items that we address. I have a little presentation here. I'm gonna.
And Paul, real quick, while you're getting that up, I just want to touch on how important it is that, you didn't just make this up and are trying to sell it to everybody, right? You're actually owner, operator, firsthand the things that can happen out there. So this is coming from experience, and I think it's a great program. So go ahead, Paul.
Yeah, thank you. I don't know why that all appeared, but I'm gonna, if I can share my screen.
I can see it.
Minimize that. Okay, so can everyone see the rethinking risk?
Yeah.
I got it.
Great. In a microcosm of what RLL is and why it was created, it was to transfer risk away from the insurance exposure that you as the owner manager has when one of your residents causes that kitchen fire or that overflowed bathtub. We are not classical renters insurance. We are a damage waiver, and the analogy that works best to understand what we do is the car rental business. So when you rent a car and they ask, will you use your own automobile insurance to cover their asset, which is the rental car, or pay an additional amount above the cost of the rental for a damage waiver, that's what RLL is. We are a damage waiver that enables you as the owner to make sure that your asset is protected from the things that your residents do, and by transferring that risk away from your property insurance. And whether you have a $500 or $1,000 or $5,000 deductible on those assets, if a resident does not have a program like ours in place or a standard renter's policy, you stand to bear the brunt of that exposure. And we're really in the business of eliminating that exposure. We don't rate or quote, so we are different than what JT does on a daily basis. Again, coming out of the habitational space, and we write this for apartments, single family rentals, student housing, senior housing, condominiums, and HOAs. We do not write mobile home parks. The idea here was to get away from a personal lines renter's insurance program where the resident is named insured, and rather systemically create a program that has you as the owner as the named insured, and eliminating, if you're familiar with renter's insurance and you've required your residents to have it, the headaches of subrogation, where you have to file that claim and then your insurance company has to subrogate against the resident's Geico or State Farm or Travelers policy. So we have very successfully eliminated those headaches for you. And as you get into this business, and I will tell you that I've been doing this since the early 80s. We syndicated, many deals before the tax laws changed in 1986, to tell you exactly how old I am. And today, real estate, especially multifamily, and single family rentals now, which is an asset class which 10 years ago honestly didn't exist, and now is booming extraordinarily. You're all in the right place. You're all doing the right things, and Julie and her other colleagues and the sponsors are resources that you should most certainly look to take advantage of their expertise and their experience. And those of you that are just starting, again, I can't tell you how important that is, and how that will really provide you with some really long-term financial benefit. So again, to talk specifics about our policy, we provide $100,000 of coverage on a per occurrence basis. There are no aggregate limits. There's up to $15,000 of personal property that's included as a sublimit. The cost is $8.29 per month. That is charged to the resident as additional rent. Again, you're not selling insurance, so you're able to add that as an additional cost. And if you're baking in additional costs to your residents, let's say for utilities or a garage or a parking space, et cetera, this just becomes another one of those additional line items on a monthly basis. There's $1,000 of additional living expenses, which means if the resident causes a loss that's covered by RLL and they have to go to a hotel for a few nights while the repairs are being made, we'll provide up to $1,000 for those additional living expenses. And there's also up to $15,000 of mold remediation, which is somewhat unique. You won't find that in most places. There's a $250 deductible, and our carrier is Hudson Specialty Insurance. They're part of the Hudson Group. They're a global carrier with some of the highest and best AM Best ratings that exist. So let me stop right there for a second and ask for any questions or comments.
Yeah. So Paul, I just want to point out, so you're saying that if a tenant causes a fire in a kitchen and it spreads to other units, right? And it does $100,000 in damage, you don't have to pay a $25,000 deductible. You only have to pay $250 and it'll get fixed.
That's
what
correct.
You're saying?
That's
and then
correct.
you'll also pay to move them if they need to be moved. Is that what you're saying?
Correct. Look at each occurrence as a bucket with $100,000 in it. And that $100,000 is designed to cover any and all property losses that occur. This is a first-party property coverage. It covers the actual unit, not so much the residents. And by that, I mean, you could have a guest come over and cause that kitchen fire. The RLL program is going to cover that. With the standard renter's policy, only the renter who's on the policy is going to do that.
Yeah,
so
and everybody, everybody, this is huge. Most of especially in Texas, most of the policies, the biggest complaint are the deductibles are just getting higher and higher and higher. Mm-hmm. This is a way to circumvent that. And like you said, Paul, most of these little instances are going to occur, just like you said, little kitchen fires or overflowing bathtubs, and you won't have to pay that huge deductible, even if it's not $25,000 in damage. Only $250 deductible. Yeah, all day. That's great.
Yeah, thank you, JT. And the other important thing to understand is that this is paid in its entirety by your resident. So this is not an out-of-pocket expense for you. This is really just upside for you. As you can see on the screen here, these are the 5 perils that we cover. Fire and water account for some, 92% of all the claims that we do cover. And, whether you have single family rentals or multifamily, this program is a great way to transfer that risk. One of the things we spoke about earlier tonight, prior to the entire group, is our carrier requires certain minimum participation levels. So on the single family rental side, the minimum portfolio size is 50 single family rentals. And on the apartment side, it's 250 units. And that can mean, one asset that has 250 units. You might have 10 assets that have 25 units or some configuration. And it can be a blend of single family rentals and apartments or student housing or senior housing, or condominiums or co-ops, whatever the case may be. But again, those are minimums that are the will of the carrier, not RLLs, and we are held, we're obligated to maintain those minimums. I will say on a national level, our minimum participation levels are the lowest of companies that do similar programs like renters insurance, et cetera.
Sure. For offering that much in coverage, yeah, they have to have a certain amount of participants, of course, to be able to help cover it. And so you said was it 50 single family or 100 single family?
50 single family.
Okay.
And 250 apartment units. And let me say, as Julie mentioned again in our early call, and by the explanation by many of you about your situation, if you don't qualify for us, that's completely understandable. But you can still, and I speak to many groups who do not yet meet our minimum requirements, but get there. That does not preclude you from requiring every one of your residents to bring you a renter's insurance policy. And on that policy, you should be listed as an additional insured or a party of interest. And you should hold a resident responsible for providing that renter's insurance policy. And you should not allow them to move in until they provide that to you, because the downside to you can be extraordinary. And by being listed as an additional insured or a party of interest, by insurance law in all 50 states, if that policy defaults or during the term of the policy or it is not renewed, you would be notified because of your standing as an additional insured or party of interest. So if the RLL program does not fit your needs today, I strongly recommend to you, again, as someone who's been on both sides of this aisle for a very long time, if you haven't started doing that, tomorrow, with your next set of move-ins and on your renewals, require them to have renters insurance. And let me say that it will not make you less competitive in any market in the United States. Renters insurance and damage waiver programs like ours are now part of the mainstream of renting throughout the country. You would be hard pressed to go into, companies that provide housing that they would not have a requirement in place. The National Multi-Housing Council, which we're on the board of directors of, in January of this year, came out with a study that almost 95% of all professionally managed communities in the United States have a program like RLL or standard renters insurance in place. So if you think that this is going to hurt you from an economic standpoint, that is not reality in the current marketplace. And again, this is a cost that's borne by the resident. So I would strongly recommend, if you qualify for our program, to please reach out to me. Julie and JT can provide, my contact information. My email address is very simple. It's my first name, Paul, at rllinsured.com. Please reach out to me at any time, and I'll be happy to discuss our program with you. And again, I want to emphasize that this is a zero cost program to you. You can also, on that $8.29, if you're so inclined, turn this into an ancillary revenue generator. Most of our clients will charge anywhere from $10 to $15 and retain the spread as ancillary revenue. And they may do so because they're not selling insurance. Keep in mind, you're not providing individual insurance policies to your residents. You're not getting into the insurance business. They are not paying premium. They're paying additional rent, again, just as they would for any other service like utilities or trash pickup or a garage, et cetera. The departments of insurance, do not look at what we do as renters insurance because it's simply not. So you have that capability to be as aggressive as you want. As I had mentioned earlier, we have clients with 50 single family rentals and 250 apartment units. And we have customers that have 10,000, 15, 25,000 units. So again, very scalable, and the ancillary revenue, is certainly, something to be considered as another, positive part of our program.
Right. And so Paul, the ancillary revenue, you've got property owners, it's $8.25 a unit for this product, right?
Correct.
And so you've got owners that are charging maybe $10 for this to their tenants, right? They're increasing their rents by $10 instead.
Mhm.
That's correct. 10,
Yeah.
right. 10, 12, 15. Again, that's completely at your discretion as the property owner.
What's the average rental insurance out there for you and me if we went out and got it? Do you know that number? I'm thinking it's like 12. What is it?
Well, very close. So the average is somewhere between $13 to $15. And again, that fluctuates demographically. That fluctuates based on the resident's credit score. In some cases, they can be as high as $18 or $20 a month. Across the board, renters insurance, and that's for multifamily. Renters insurance for single family rentals is more expensive. Those numbers go from anywhere from $18 to $25.
So yeah, you tell me you move in here, we've got renters insurance covered. You don't even have to tell them the price, right? But if it's $10, well, great, you're saving me money and I don't have to make a phone call, right?
Mhm.
Right. And we have two models, and then I'll open this up to questions.
Yeah, go ahead.
From everyone. So we have two models. The first, as you see here, the PDLW is an acronym for our product, property damage liability waiver. And again, because this is not standard renters insurance, you have the ability to require upon move-in and renewal that all units participate. Again, you can't just start tomorrow and start charging all your residents. You have a lease agreement. It's a viable contract. You can't amend that contract without the resident's approval. So our customers will, if they started tomorrow, would begin with all new move-ins and renewals. That offers the maximum protection, offers the potential of the most revenue, and most importantly, gives you the peace of mind because you know that if the price of the RLO program is added to the monthly rent, the residents paid that, this coverage is going to be in place. One of the things about the renters insurance, as I mentioned, you can be listed as an additional insured and party of interest, but you still have to track that. And the sad reality is, and again, these are not our statistics, these are the industry statistics, up to about 50% of those renters insurance policies are dropped before the end of the policy term.
Mhm.
So they'll tell you they have a policy, they'll show it to you so they can get into the apartment complex and then they'll just cancel the next day. Is that what you're saying?
Right. And then we also have a select model, and it's exactly what the model is. You're giving your renters the choice of our damage waiver, or they can bring you that third party policy from Travelers or Geico or State Farm. And that would meet the requirement as well. We also have our own renters program. It's called RLL Protect. It's another way to give the resident the opportunity, and especially if you're already out in front of this and you're requiring your residents to have renters insurance, a nice way to leverage this coverage is to include the RLL damage waiver along with offering a renters insurance to your residents, and then you can transfer this risk in that method. Again, I have these conversations, on a daily basis. The whole idea here again is to get this exposure off of your deductible, to get this exposure over the negative impact it has on your renter's policy, your property policy rather. And people always say, well, Paul, look, I have property insurance. I have a P&C policy. Why do I need RLO? Well, it's like bad drivers. If you're a bad driver and you keep submitting claims for to your auto coverage, what happens? They drop you or your rate goes through the roof. Well, the same thing happens on the property side. And that's where we shine, because any of the losses that are covered under RLL never get to your property loss experience. Envision RLL as a brick wall in front of your P&C policy. And those losses that we cover hit that wall, fall to the ground. They never appear in your loss history. So just think about this statistic or these statistics. 75% of all fires and all water discharge episodes in multifamily occur at the hand of residents. So imagine if you could create a means to move 75% of those losses off of your property policy. And that's what RLL does, because those losses are going to hit the RLL wall, fall to the ground. It's going to be as though they never existed. So now what happens? Your loss ratio, which determines in a large way what your premium is going to be upon renewal, has now decreased dramatically.
Right. And I just want to touch on that real quick. I have some property owners that, they'll call me for all kinds of things, right? And I always recommend call me, let me know what happens. Don't go straight to the carrier. Call me first and let's see what's going on. Even things like, oh, a car ran into the building. We got to call the carrier. I'll say, hold on, wait. Let's see what's going on. Let's see, was anybody hurt? Let's get the report. And then it turns out that the damage was only, it was $10,000, right? It looked worse than it was. It wasn't that much. If you go to the carrier with every little thing, even though you don't actually make a claim officially, if you just go to them, well, guess what? In their eyes, you're riskier than the property across the street that never comes to them with anything, right? And so with this RLL program, all these little things that could happen with these tenants, you don't have to go to your insurance carrier. They don't have to know about it, and that will save you at renewal, I promise you. So that is huge. And yeah, thanks for bringing that up, Paul. That's great.
Thank you, JT. And the last part, and again, we really look at RLL in three components. The first is the policy and the coverage. The second are the economic benefits, which I mentioned, where you can generate ancillary revenue and also eliminate the exposure to the deductible. And then the third part is the administrative piece. We handle everything from A to Z in this program. So we distribute the policy, we handle the billing, we handle the receivables, we train all of your leasing teams on how the program operates. We provide sample lease addendum, sample renewal letter. We have informational pieces to the residents. We have videos, et cetera. So we have compartmentalized all of this process. And again, through our training team, which is based out of our Salt Lake City office, these training sessions are available, at any time as you have changes to your leasing teams. And we always encourage you as the owners to sit in on those trainings, especially in the beginning, to see how this works. We also automate this process with most of the major property management software platforms throughout the country. And again, everything that you've heard about tonight costs, the $8.29. There are not additional charges for the training, for any of the administrative work. And the way that the billing works is for single family rentals, we'll send one bill each month to your central location. For all of the single family rentals that are in the program for that month, we send you one invoice for that. On the multifamily side, you have the autonomy to determine whether you want those invoices sent to the community or to a central location. I don't want to get out in front here. Again, because of our unit minimums, I hope that, some of you that are able to participate, will certainly, reach out to JT and I. JT would really be the point person on this. And I know that his information is available as well. So Julie and JT, I greatly appreciate the opportunity to speak here tonight, and now open this up to any and all questions and comments.
Yeah, thank you,
Fantastic.
Paul.
That was
Yeah.
great, Paul. I love what you shared. I'm curious, JT, when you put this on, include this as an option, what is the reduction of the insurance policy that you would expect or think about from a premium policy?
I mean, it all depends a bit. It could be thousands and thousands of dollars. It depends on what's going on at the properties, but I do know that his stat, was it 95% of these accidents that happen there are from simple things. It's usually grease fire in the kitchen or something like that, or a sink overflowing. So unfortunately, it happens so often, but owners know that it doesn't cost that much to fix, and my deductible is $10,000 or $25,000 or whatever. So they don't even end up making a claim, and they have to pay for that out of pocket. With this, you don't have to pay for it out of pocket, and you don't have to tell the insurance company anything. As far as they know, everything was great all year long, and when it comes up to renewal, you look like a great owner, and yeah, they want to keep you. Your loss ratio is great. So yeah, it could be thousands and thousands and thousands of dollars.
Yeah, and JT, that's exactly right. And Julie, to sort of elaborate on the answer as well, one of the things that we've seen, and we've been doing this a long time too, is there's sort of this hidden or underbelly issue here. And some of it is, let's say you have a $2,500 deductible. Many owners and managers, if they have a $3,000 loss, will not submit that $3,000 deductible because of the adverse effect it has upon their loss ratios.
Sure.
So when we speak to groups about coming into our program, we ask them to analyze that as well, because that's something that many companies just assume and digest as the cost of doing business. So that and especially for new groups starting out and smaller group, and again, I say smaller groups. If you have 5 or 10 units, that can really turn out to be a substantial benefit and can really turn around the economics. We've also, and again, we have a really diverse portfolio, but we have seen our clients over the years, and again, to JT's point, there are so many variables that come into this, but I think it's important to articulate that we've seen clients of ours have 5 to 15% discounts on their property premium. And again, this is over a span of years. If you're familiar with what's going on in the property markets over the last 3 or 4 years, there's been great disruption there due to so many of these catastrophic losses out there. And even though we're a small niche product and a tiny sliver of the overall property insurance business, we nonetheless are in that same sandbox. So it impacts us. But that's a great question, Julie. And look, it's really comes down to common sense. If you're eliminating claims to your carrier, carrier's very happy because it's out of sight, out of mind to them. And as JT also alluded to, if the loss is under $100,000, there's no need for you to even let the carrier know about it. Not that you're trying to be disingenuous. It's just, you have another method to handle that exposure.
As far as they know, you took care of it out of pocket, right?
And especially if you can pass it through. How's this not a win-win situation?
Yeah, no, exactly. And Paul alluded to it. If Ed had maybe a $10,000 deductible out there and he had $11,000 worth of damage, and I'd still tell you, well, you're going to pay this deductible, you're going to add to your loss ratio, and you're only going to get $1,000 out of it. You know, you probably don't want to do that, right? So those higher deductibles, those are for much bigger things. So this project is for all those little things that are happening out there.
Look,
So
it
this
comes
is
down to, again, and this is not any great revelation. It's those three magic letters, NOI. And every dollar that you add of NOI, and I don't care, pick the multiple, you increase the value of those assets. And that's really what we sell. We're able to, through this program that the residents pay for, increase the value of your assets, because every dollar that you goes to the bottom line, and I see Julie smiling there, because on the equity side of these deals and the financial side, it's huge.
Yeah, it makes a big difference, and such a great, what a great product. Carrie Love, I see you have a question, and let's open this up to everybody else. Whoever has a question, if you would, you can either unmute yourself or give me the high five, and I'll call on you. Carrie, what do you got?
Paul, this is Carrie. The implementation, so you said it was 50 single families and 250. So if it's across different entities or different property managers, how does that come into play?
So Carrie, that's a great question. So I guess I need a little more detail. When you say across property managers, are you referring to 3 or 4 separate property management companies who work together?
No. So if you have single family homes, and let's just say that you have 50 or 60 or 70 homes, but they're in different cities and managed by different property managers. So, you know, somebody manages 20, somebody manages 15, somebody manages 9.
Sure, Carrie. I'm sorry.
So for me, it would be a total of, the minimum is fine, but they're going to be in different entities. They're going to be across the board. So how do you count those?
Yeah, Carrie, I'm sorry, I misunderstood your question. So we do that all the time. We'd put them under a general entity that, you know, you would want them under, Carrie Love Associates, and we would account for them individually. We do this with fee management companies throughout the United States who are doing, you know, 15,000 units spread out that way using multiple management companies. So that's right in our wheelhouse, Carrie, and is a staple of our business.
Love it. Does that answer your question, Carrie?
Yes, it does.
Thank you. I know that there was a question about, do we have a one pager that maybe you have available that we could provide? Because we have folks that are working with other syndicators that couldn't make it today or want more information. Do you have a summary perhaps that we could make available?
JT could provide that to anyone. We have a one-page summary, and then we also have a 2-page of case studies. And it's 4 examples of their real losses. And we have those both for single family rentals and for apartments.
That's fantastic.
I would also,
JT?
I apologize, and I'm sorry I didn't mention this because I've been doing this since I'm 2. Sometimes I forget things. Please visit our website, which is simply www.rllinsure, that's insure.com, and everything that I've talked about as well is there. But JT and I decided that he would be the point person, and if you reach out to JT, he can send you our program summary and that case study.
Yeah,
actually,
to make it easier for Paul, you can reach out to me and I'll get you all the information you need. So just let me know if you're interested in more.
Super. And you know what we'll do is, JT, if you could get that to me, I'll have it sent in the Friday. You guys should all be getting an email that has the link of today's presentation, and we'll put it on there. So look for that. If you're not getting any of those links or the emails, please let me know that as well. All right, Alan, did you have a question, or you just like being unmuted?
I do have a question.
Good. Go ahead.
So I think this is, my camera's freaking out a little bit here. This is a question I think for both you guys. So I'm setting up a national program to acquire, renovate, stabilize, and sell REO assets. And in addition to the syndication work I'm doing with people here in the group. So my question is, between the two of you, are you able to insure the property from acquisition through renovation, through rent and stabilization and sale? And is there a minimum time period that a person has to be in a unit, or that I have to own it for your coverage, Paul, to cover it? Like, you know, I rent it day one, or they cover day one, and if I sell it on day 30, is that good for your process, or do you need me to own it more time for it to work for you?
Alan, so our program is triggered by the action of the resident. So if you're in, development or repositioning and the unit's vacant, it would not be applicable to have our coverage in place.
No, but at a certain point, I'm gonna, after the property is completed, I rent it to a good tenant, and then I sell it in blocks of like 100 units at a time, already rented and stabilized. So to a buyer, to an investor. So there is that period of time where it is leased and I still own it.
Sure. Well, the coverage would be, if the units are occupied, absolutely. We would provide that coverage.
Okay, perfect.
And Alan, I can help you through the entire process there.
Great.
It depends on exactly what you're trying to do as far as who the named insured is and all that, but we can iron that out, sure.
Fantastic. I do have one last question. I want to make sure you don't underwrite mobile home parks. Is that correct? Paul?
I'm sorry. Right. Mobile home parks are the only habitational asset class that we won't write.
Okay, so everybody, if you've been doodling on your computers, remember, this is for people that are living in apartments. This is not for industrial, none of that. That's not the tenant we're talking about. We're talking about people living in these apartments.
Or
I do have a,
family.
or single family, correct. What happens if you have roommates? Do you buy one or is it two? You've got husband and wife, that's one. If you've got roommates or you've got a bunch of kids that are adults, how do you underwrite that?
We follow the lease. So if and again, because this is first party property coverage, if on the lease there is one lease for unit 101, then only one RLL is required. In the case, for example, of student housing where they lease by the bed, then in that situation, it would be applicable to have the coverage on each of the individual beds. We have seen, single family rentals where they are rented by the room. Again, ours is
By
a
the
very
lease.
pliable product. We just follow whatever the leasing pattern is that the owner has in place.
Fantastic. I love it.
And Paul, I've got two more questions real quick. Will it cover tenant wear and tear on move out?
It will not. That JT historically is the domain of a traditional security deposit. So you're moving out of the unit and your friends crash the couch into the stairwell, or you've decided you couldn't figure out where to hang the 20 pictures you had, so it looks like someone shot a machine gun at the wall and 100 holes, or someone has damaged the kitchen counter, or you had a pet and the pet chewed on the side of the door, or anything that's always associated with security deposit would not be covered under our program.
Right.
Our coverage
unless it covers one of those covered perils, right?
Right.
Yeah,
It's real time, fire, water, explosion, smoke damage, and the resident caused sewer backup. Someone drops a hairbrush in the toilet, or or kitty litter down the kitchen.
So I guess if they're moving out and the cause of an explosion, then it might be covered, right?
All right, we got two more questions and then we got to rock and roll.
Yeah.
Wakefield, what do you got? What's the question?
Hey, Paul, for this type of renter's insurance, what are the typical ways that you implement if the tenants at this property haven't been used to a renter's policy, or is it more of when new renters are coming in, you create that new policy or embed it as part of the lease requirement? What are some best practices that
Yeah,
you?
so Wakefield, it would again be upon move-ins and renewals, and it becomes a management decision that, if you want to migrate into our damage waiver. And again, it's very important, and if you take anything away from this discussion tonight, this is not renter's insurance. And they are really two very different ways to transfer risk. So again, the move-in and renewal is been the sort of time-honored approach to implementing the program.
Okay, Raymond, you've got a question. These are all great questions.
I have a question. Okay, let's say I don't have enough units to qualify. Can I qualify if I can get my property management company, if they manage, let's say 1,500 units, and they offer this to the owners? Is that another way around it? So let's say I only have 10 units, but my management company manages 300, and they're offering it to us, the owners, through you. Is that a way around?
Yes, Raymond, absolutely. If they had the qualifying number of units, then that scenario could play out.
Okay, that's excellent.
Fantastic. That is a great question. Jim asked a question, and it is about Jim. How did I lost it now? Where'd it go? Okay, Rick, Jim, are you also offering rent and lease guarantee? Is that right you say? And also, do you have security deposit products?
We do not have those
Rent and lease.
products. We have partners that provide those services for our clients that are aligned with us, both security deposit alternative and also on the rent guarantee.
Okay, great.
And we're happy to introduce you to those groups.
Okay. Rick says, does the premium of $8.29, I think it was, per unit change based on the property type, whether it's single family or apartments versus townhouses, Class A versus Class C? That's number one. And did I understand it correctly that premiums doesn't increase if there is a claim?
So let me answer all of those questions. So the $8.29 is regardless of asset class. So it could be A+ in downtown Manhattan, or it could be C- in a part of the country. The prices are guaranteed for a year. The program does have the capability. 60% loss ratio is the magic number in insurance. And that simply stated is, if you pay $1 in premium, the carrier doesn't want to pay more than 60 cents out in losses. So in the rare cases that we've seen clients of ours that have exceeded that 60%, there might be a 10 or 15% increase for a year. And then if their loss ratios come back down, then we bring the price down. There is a price differential for single family rentals, and that's the only price differential. And that price is $10.60 per single family rental. And again, that reflects, as I mentioned earlier, the difference between a standard renter's policy for an apartment versus a single family rental. And the psychology or the methodology there is these carriers determine that these single family rentals are so geographically spread out that the response time is not as quick as you'd find in a multifamily setting, where the response time is much greater. And again, those are actuarial studies for people who determine those types of risks and affirm prices to them as well.
All right, Paul, before we go, can you give us your phone number, your email one more time? I got your website, but if someone wants to reach out to you, you want us to go to JT, right?
Yes.
Okay.
JT is the point of contact, but again,
Okay.
my email address is my first name, Paul@rllinsure.com. And my phone number is 201-819-3215. I am a Jersey boy at heart, crossed the river about 10 years ago. So if you're familiar with the 201 area code, I know someone mentioned Newark. I grew up in Jersey City, right across the river there. So that's why I still have my 201 area code.
Well, we
Julie,
still like you.
I want to thank you and JT and everyone on the call. Really appreciate it. And even if you don't, qualify or do business with RLL, if you have any questions, about this whole space and, the value of transferring that risk, please reach out to me at any time. So
Thank you so much, Paul. So appreciate your time. As I mentioned earlier, it might not be for you today, but if you're an LP, it may be something that you suggest when you're going through their webinar and you say, hey, we're going to be increasing the income. How about have you looked at this as an opportunity for them to scale that income, the NOI, right? And if you are being a GP, can you consider this on your next deal or your next deal or your next deal? I think it's really important. So Paul, thank you so much for joining us tonight. I do appreciate it. I know it's late.